We're here to talk about the Silicon Valley real estate market analytically on August the 10th, 2024. And then we'll finish up with the Greater Bay Area, which includes 13 counties in Northern California as presented in 5 regions. We'll come back to these green rooms later. I'm Richard Calhoun, real estate broker here in Silicon Valley, working with buyers for sellers. And if you're interested in my prediction of where the market's going, that starts on slide 77. We start off with where the market actually is. Here is sort of a summary of where the market is. This is going back for a full quarter, 14 weeks, because I include the ends of the quarter. What you start off with is inventory. So a quarter ago, we had 2,036 homes on the market. That was 83% of the normal level of inventory. The gray line is the normal level of inventory. You can see the separation between the purple and the gray line has increased, which means that we have a greater shortage since we're on the red side. Shortage of inventory is tending to give you a red hot seller's marketplace, and that's why it's red. More inventory would give you an ice cold blue buyer's marketplace. So now we have 2,400 listings. So we have almost 20% more listings on the marketplace. But typically at this time of the year, the rate of growth is even more. And therefore, we're only at 77% of the inventory you'd expect. On offers accepted, you can see there was a huge shortage of offers at the beginning of the quarter. We only had 74% at 2,100 offers accepted. We now have fewer number of offers accepted at 2,000, but the percentage of offers has increased to 80%. So we're closer to normal, and that's why we're above the blue line. And more importantly, we're closer to this gray line now. We're only 20% below, where here we were 25% below. And that is how you read this whole chart. Moving on to days unsold inventory. This is the seller-buyer balance, supply-demand balance, the active inventory versus the buyer demand. And you can see that we started off at 34 days at the beginning of the quarter, which was, is a fairly fast-paced marketplace, but that was 10% slower than it normally is. Now we're only 3%, 2.5% slower than we normally are, but the speed of the market is a lot slower at almost 44 days. So you've gone up 10 days. It's taking 10 days longer to sell out your existing inventory, but yet the market is faster relative to where the market normally is. That shows you how cyclic this real estate market is. There's a huge annual cycle. There's huge weekly cycles. And that's why I do my data based on weeks, not by calendar months, as almost everybody else I'm aware of does. Then for the buyers and sellers and consumers out there that don't like statisticians playing around with a number, this is pretty easy to understand. It's basically marketing time. How long does it take for 3 out of 4 sellers to sell their property? At the beginning of the quarter, it was taking 13 days, and that was basically 79% of normal. So it was a little bit faster than it normally was. And that's why you're now, instead of being on the gray line, you're almost on the red line. Red line favors the seller. Now you're at 22 days, so you've gone up by almost 50%. You're taking 50% longer to sell the property, actually more than 50% longer to sell the property. The percentage of normal is basically right at normal, 99% of normal, and that's why the purple line is right on top of the gray line. The gray line that I keep talking about is normal. For all these measures, that's the past 10 years, not including the current year. So I go back 1 year to 10 years back, and I look at what that median value is, and that's how I define the typical or the normal. Now moving on to price cuts. You can see that at the beginning of the quarter, we were taking 0.4% price reduction, and that's actually 40% more than normal. So normal would be some number around 25%, I would be my rough guess, or 1/4%. Now you're taking 0.43% price reduction. So you're almost 50%, 41% greater price reductions at the beginning of the quarter. And because they were greater, it was favoring the buyer, which is why it's on the blue line of normal. You can see we almost touched normal through here, and we're pretty close to normal now. And so your percentage of normal is down to 16%, bigger price reductions now than typical, but the price reductions that you're taking are double. And that's why what's maybe a little confusing about all this data is the numbers doubled, but we're getting closer to normal. And that's because price reductions are normally larger at this time of the year than they are a quarter ago, 13, 14 weeks back. And now if we look at overbidding, overbidding started off the quarter at 9.7% above the seller's asking price. That's 3% more than normal. So normal would be 6.7% above. And that's why you're getting towards the red line on this graph. Here's your gray typical line. Sellers market's way up here on the red line. But now look, the market's turned around and come down. And so now we're at 5.6%, which is actually 0.3% less than normal. So normally you're at 5.9% at this year, which is now why the purple line is just below the gray line. You can see the gray line just above the purple line. We're getting less overbidding now than we typically do by 0.3%. Here's the three key components. You start off looking at the inventory on the purple. You're basically at about 78% of normal. The level of offers accepted is 76% of normal. So those two are fairly close together. That's giving you a DUI of about 100.5% of normal. So DUI, the speed of the marketplace, is almost normal. You can see that the market was slower in the past. We were up to 110 to 120% of normal. So 10 to 20% slower than normal. Now you're less than 1% slower than normal. For all intents and purposes, the speed of the marketplace is normal with a lack of transactions and with a lack of inventory. Now we're going to just start off looking at three key indicators. We're doing this by looking at the distribution. So these are distributions at a point in time. They're weekly distributions. I have my real estate calendar that starts on March 1st of every year, jumps forward 1 week at a time, gets around to February 21st, and then instead of jumping forward a week, it jumps forward 8 days back to March 1st, and on leap year, it jumps 9 days back to March 1st. And that's why my real estate year is based on a March 1st start date. And that's so that all the discontinuities are grouped in that one period of time on basically February 28th and February 29th of any given year. So here we're looking at days on market. So this is how long it's taking the long typical seller to sell, and that would be the 75 percentile mark right here. So the purple is the current line, so you're somewhere right around 28 days to sell the properties. Now, a year ago, you were down here at a number of 20 days. So it's taking roughly 8 days longer, a full week longer to sell the properties this year than last year. But what we're doing is we're going to start off a year ago, which is the blue dotted dash line down here. We're going to jump at 4 or 5 weeks at a time. So September 6th and October 11th and November 8th. And we're going to see how the market slows down at the end of the year, then accelerates at the beginning of the year, and then slowly drifts down. So let's just step through and watch it happen. So here you're bouncing around, and now you're slowing down. This is the end of the year. Right there's January 10th. Then you're accelerating really rapidly, and there's sort of the peak of the market right around April 12th. And now you're sort of going to slowly move down until we get to the purple line up here. The dotted lines were the oldest lines, the dashed lines were the next most recent, and then the solid lines that we're on now are the most recent lines. This purple dotted dashed line here, which is the current week, is above the blue dotted dashed line of a year ago, and it's closer to the blue dash line up here, which is my all-time record cool marketplace. So the market is definitely slower. It's taking sellers longer to market their property this year than it did last year. Moving on, doing the same thing with price adjustments, and these are sellers' adjustments of their asking price in order to get the offer to come in the door. You can see the purple line, the current week up here, is slightly above the blue dashed dotted line down here. Now, basically, it's 7.5% of the marketplace and on, and probably something close to about 6% of the market on. It's right on top of one another. So basically, it's only the 6% of the sellers that are taking the biggest price reductions, took bigger price reductions last year than they are doing this year. That's a reversal from, I think, just last week. And I think the change was more in last year's data, but I'd have to look at that more. So again, stepping through, starting off on the blue dotted dash line, which is a year ago. These dotted lines are the old lines. So those are the oldest. So now you can see that you're cooling down. So right there, sort of the slowest in the marketplace, again, January 10th, and now you're accelerating. And right there's the peak of the market, May 10th. Now you may say May 10th, where is that coming from? That's one of the time frames when I'm only looking at 5-week increments or 4-week increments potentially. And so I'm jumped over the April 19th and April 26th, which was actually the peak of the marketplace. And during that explanation, we all finished. So again, we're back to the current week on the purple line here. And you can see you're above where we were last year. So sellers are actually taking slightly less price reductions this year than they did last year. And you might will say, why are you only worried about 6% of the seller marketplace? Keep in mind, when you get back here to just 12.5%, those sellers are taking no price reductions whatsoever. So having a whole bunch of zeros in your data doesn't help you at all. And that's why I'm looking at just the very biggest price reductions, the sellers that are taking the very biggest price reductions. And the reason for this is sellers typically are going to be doing their homework before they put their house on the marketplace, and having your house on the market isn't the most enjoyable process. So they do price their home to sell their home, and therefore they don't have to do many price reductions. Or potentially another way to look at it is if we're selling 75%, 3 out of 4 homes in less than 28 days, sellers don't even have time to do price adjustments. And finally, we're now looking at what the buyer side's doing with overbidding. And you can see the purple, the current line, is just ever so slightly below the blue line of a year ago. So the market is slightly cooler this year than last based on the amount of buyer overbidding. And we'll step through and you can see the little bit of bounce. And now you're going to be cooling down for the end of the year. Right there is probably the bottom. Now you're going to do huge accelerations. And right about there is the peak of the marketplace, May 17th. And now you're going to sort of slowly drift down. And now we're into the most current weeks with the solid lines, and you're continuing to drift down. And that's where we are now. What do you expect to go forward? Well, you'd expect the trend to be the same. We started here a year ago, and then we basically bounced a couple more weeks, and then we went down. So we have a couple more months of 4 or 5 week increments, before we start to see that drift down. Now on slide 73, we're getting to sort of the predictive. And the reason I say it's predictive, I'm not going to predict where the market's going, but you come over here to the right side and you can see the normal pattern of the marketplace. So the gray line again is the normal line, and that's defined based on the past 10 years median. The blue line is where you'd expect inventory and how you'd expect inventory to behave in a cold year. And the red line is where you'd expect the inventory to behave in a hot marketplace with limited inventory. This year we're on the purple line, which is the current data, and it's between the gray line and the red line. So you're between a limited inventory and a normal inventory, and you are limited inventory. You have something like 2,400 homes instead of a number closer to 3,000. So you're basically 20%, and I think the number was 78%, or maybe it was 79% of the inventory that you'd expect to have. So we're missing 20% of the marketplace roughly. And what you'd expect it to do is expect it to follow sort of a hybrid between the gray line and the red line. So you'd expect inventory to sort of be flat for the most part. And there's been really no change compared to where the market is. And you can see that on this chart. Here's compared to normal. If it was a normal year, you'd be right up here on 100% line. So you can see that you're basically just below 80% of the inventory you'd expect to have. And you improved ever so slightly last week, but I would call that pretty flat. Now looking at the number of offers, here the number of offers is actually below the least you'd expect. So if we look at the last 10 years and we take the 10 percentile on that, that's how you get the blue line. So we're actually lower number of offers being accepted than you would ever expect, even in a cool marketplace. You're going to have them, and you've had them in the past, in the second half of 2023. It's not unheard of to have that low level, but we definitely have a low level of buyer activity getting offers accepted. And then what you do is you compare this to the gray line, which is how you'd expect the market to behave. And it's sort of flat, it's sort of flat. So I'd expect real no change on my percent of change. And basically you can see it's fairly flat. At the beginning of July, we did a little dip down, but that's just the holiday. And I believe that was because July 4th this year was Thursday, I think. So people were traveling on Wednesday. So at that point, they may as well take Monday and Tuesday off and get a whole extra week out of it. And a fair number of people did that. So the holiday impact of July the 4th this year was bigger than you would have expected. And that's what this little dip down here is. But basically, the offers are being somewhat at a level plateau. They were at 70% for most of 2023 and the beginning part of 2024. Then we improved, and we're some number around 75% of the marketplace now. So we've brought back an extra 5%. Now we're looking at days of unsold inventory. Here, your days of unsold inventory are almost right on top of your black line, so almost completely normal. And that's because you have roughly the same amount of shortage of inventory as you have a shortage of offers, which gives you a normal speed of the marketplace. And you can see that right here. You've been improving. We were cooler than normal for a good part of the second quarter. Now third quarter has seen an improvement and a return to normal. It almost appears that this is going to turn around and become a hotter marketplace. Time will tell, but that's the direction. Now here's your 75% days on marketplace. So this is 3 out of 4 sellers are selling in less than 21 days currently. And that's basically right at normal. Normally it's climbing during this third quarter. See how rapidly this line goes up third quarter? Basically, if you look at it, we spend from the middle of January, roughly, all the way through first quarter, we drop like a lead balloon. Then the second quarter is mostly a level plateau. Then third and fourth quarter, we're slowing down dramatically. And that's the huge cycle that we go through every year. And you can just see it in the graphs historically. We go back to 2014. This is where I'd expect those lines to be going forward based on past performance. Now, if we have some economic or social event happen that knock everything out of whack, these lines are going to be irrelevant. But based on a typical marketplace, which is what we're more or less having with limited inventory and limited offers, you'd expect it to follow the gray line. And here you can see you're actually a little bit hotter than normal, and you've been fairly flat. So you're moving a little bit faster than we typically do. Here's the sellers that are taking the largest 10% price reductions. And again, you can see that these have been increasing fairly recently, basically all of second quarter and all of third quarter. You can almost draw a straight line down. Even the typical normally drops during second, third, and fourth quarter. In a hot marketplace, it still even drops. In a cool marketplace, it drops. So it's not uncommon. We're basically doing the typical real estate cycle for Silicon Valley. And you can see that we're taking about 20% more price reductions than we typically do, but we've been at that level for basically almost a full year, starting at, partway through fourth quarter of last year. So we're at least 3/4, a little over 3/4. We've been right at about 20% more price reductions than typical. Here's the average price reduction. So now, for those that prefer, I'm trying to show that the reason why I focus on 10%, and that's because so many people take 0%. This is a tight metric. This is 0.2%, 0.4. I mean, you're talking about a marketplace that basically goes from 0.2% down to maybe 2.2%. So you only have a 2% swing, and that's the big swing. Your typical marketplace only swings from 0.2 to 1%. So you only have 0.8% swing. But again, you can look at the purple line and you can see that we're falling away from the gray line more rapidly than we typically do. So we're moving into a little bit of a cooler marketplace. And you can see that in the last couple weeks here, where it's done an abrupt turn. It's been fairly flat. It's done an abrupt turn. Now, This could be a V and go up to next week, no problem. But for right now, you're headed towards a cooler marketplace, which means sellers are taking bigger and bigger price reductions compared to what they typically do. Here's the frequency of the ask price reductions. So how common is it? And you're right on top of the gray line and you're following the gray line. So you basically have a normal marketplace happening. And basically what that's saying is because the magnitude of the price reductions were bigger, it's saying that the sellers that are doing price reductions are doing larger price reductions, not that more sellers are doing price reductions. And here you can see you're right on the normal line. It looks like we were a little bit below last week, bumped up, and we're right on top of it this week. Here's the average magnitude of overbidding. So now we're flipping over and looking what the buyers are doing. So right now we're overbidding a little bit more when you look at all of Silicon Valley. So that adds in Santa Clara, San Mateo, and Alameda County. It's not dramatically more. This is going to be something like 3.5% overbid, and the typical for this time of the year is about 3.25%. So you're taking about 0.25% more price overbid on average. The magnitude of overbidding is completely right on normal. So you're basically right at the normal level of overbidding. Here's the frequency of overbidding, and you can get in and see the frequency. Now it's just a hair above, but basically that's slightly favoring a hot marketplace that you were on the gray line last week, and you'd be down here, and since you didn't fall as much as you normally do, that's going to be moving on this next graph a little bit away from the gray line towards a hot marketplace, and that's what we're seeing over here on the frequency. So we have slightly more frequent, about 2% more sellers getting overbidded at this time of the year than we do. So it's slightly less magnitude of overbidding, but slightly more common. These are small enough changes that both are probably right at the normal level. And here is the price for the Silicon Valley. And what you can see, the most prominent feature, I believe, is this V shape at the end of the year. Yes, it was missing in 2021, but we were on fire. It was even mostly missing or turned into a U in 2020, but both of those were related to the pandemic. If you eliminate those 2 years, every year has this V at the end of the year. Yes, the shape changes a little bit. So basically that says that the prices at the end of the year are lower than the prices at, say, first quarter. And the second most prominent feature is this upside down V or U that we have every year. And it's not every year. We missed it for the pandemic, but for the non-pandemic years, it's pretty common. It wasn't all that noticeable last year because the market was crashing. So you got above it a little bit, but the market was crashing, which almost put you on a straight normal line. That's why it's important to pay attention to cycles. If you bought here, and remember there's a 5-week lag time. So if you bought at the end of 2023 versus at the second quarter of 2024, you would have bought a whole lot more property for the price. Rough numbers here, you can come over and see you're at 1.4 and now you're at 1.75. So you $350,000 difference on the typical median priced home. That's not insignificant. So if you are able to adjust the timing of your purchase or sale, you can make a huge impact on your rate of return. And something else people don't pay much attention to is with the current tax laws that we have, it almost makes sense for people to sell their home once they get to use up the $250,000 exclusion, and that's per person, per owner. 500,000 for people that are 250 for single. I believe 3 people in a partnership could do 750 because you would each take a third of the property and take your 250 exclusion. But once you're at that limit, you're now giving up whatever your capital gains tax rate is. And for a lot of people, it's going to be around 40%. You're giving up 40% of the future appreciation of that property. And that's far bigger number than the increased hit in property tax. And once you're over 55, you can start moving that prorated share of your property tax with you, provided you continue to own or occupy the property. So it doesn't work for properties that you move into for 2 years to get your exclusion and then convert to a rental, because you lose your lower non-property tax basis. Here's your estimated payments. This is the most expensive, assuming an 8% loan. They came down fairly significantly last week because there was about a 0.25% drop in the federal rate for the nation. Jumbo rates in California tend to be a little bit lower, and jumbo rates in California are lower than conforming rates. So keep all that in mind. These are just estimates to show you the relative nature of them. And to give you an idea, the federal national average was something like 6.5%. And I think even last week, I think I saw Wells go at 6%. So it's a 0.5% lower. But this would be for the 90% the most expensive, and it would be atypical for a person buying the most expensive homes to be doing an 80% loan. Very typical for the starter and the typical buyer to be doing an 80% loan, or maybe even a 90 or 95% loan. Now we're breaking it up and looking at the 3 counties individually: Santa Clara County in the blue, San Mateo County in the orange, and Alameda County in the gray. Alameda County has the most active inventory. You can see that that's typically where they are, but Santa Clara is normally closer to Alameda than it currently is. So Santa Clara has a bigger shortage of inventory than Alameda County does. Offers accepted very close together here, but Santa Clara is on top. So Santa Clara had less inventory and more offers accepted. So on the next slide, we're going to expect Santa Clara to have a faster speed of the marketplace, which is a lower DUI, and it does. In fact, it's got the fastest, and Alameda County's got the slowest market at 48 days, and San Mateo County is in between at 44. Here's time on the marketplace for the 3 out of 4 sellers. Again, Santa Clara County is the fastest. San Mateo is right at a month, and Alameda County is at 32 days. Here's the magnitude of the price reductions. Santa Clara County is taking the lowest amount of price reductions, and that might make some sense because we were the fastest marketplace. Alameda County and San Mateo County are close together, but in their reverse order of what you'd expect. Alameda County had the slowest DUI, so you'd almost expect it to have the largest price reductions, but they're close enough together that that's just statistical fluctuation, which shows you the real estate market's an imperfect market. Here's the frequency of price reductions. Alameda County has by far the most frequent price reductions. Santa Clara County has the least, and San Mateo County is in between. Here's the overbidding, and this is sort of interesting. Alameda County had the slowest market, but yet it has the most aggressive overbidding. Santa Clara County had the fastest marketplace and had the least amount of overbidding. That is the exact opposite of what you'd expect. If the market's moving quickly, that would tend to indicate that the buyers are in a frantic to get a house. But here, the amount of overbidding in the fastest moved county, Santa Clara, is actually the slowest. Just an interesting observation. To get anything over asking price is pretty unusual for expensive items. In Silicon Valley, it's pretty normal. You can see for the last 10 years, only time we were below 100% was only in 2 counties right at the end of 2023. But again, right now, Santa Clara County has the least amount of overbidding, but the fastest market. And Alameda County has the most overbidding with the slowest marketplace. So not what you'd expect. The frequency of overbidding, San Mateo County has the least. Santa Clara County has the second most, and Alameda County has the most overbidding. So the slowest market, Alameda, has the most magnitude and the most common overbidding. Here's the long-term appreciation. Santa Clara County still has the most appreciation at maybe 92.5% appreciation since the last 9 months of 2015. Alameda County is second at somewhere around 75% appreciation, and San Mateo County is at about 67.5% appreciation. So all 3 areas are showing pretty good appreciation since 2015, but it does vary with Santa Clara having the most appreciation. Here's your price going back, and I believe this is on a log scale. I actually added in these lines to give you some idea of the price. San Mateo County is the highest price, and I think the real takeaway here is that's right about where the prices were in 2021. So we've gone through a huge cycle up and down and then up and down again in San Mateo County, but basically prices are back where they were in 2021. In Santa Clara County in the blue, prices today on right here coming back are quite a bit above where they were in 2021. And Alameda County is like San Mateo County and right at their levels. Santa Clara County has outperformed both San Mateo and Santa Clara since the pandemic. Here's the same thing on regular paper for those that have preferred. Here's the estimated payments that are going to be in the same order. Alameda County is the cheapest county with payments of about $9,500, followed by Santa Clara County, about $13,600, it looks like. And San Mateo County is going to be the most at about $14,200. Here's a summary of the micro market areas that we're going to get into. The first two are just active inventory and offers accepted. They by themselves don't tell you where the market is. You start getting into the yellow highlight columns. These are leading indicators. So where's the days of market compared to normal? Red would be a hotter marketplace. Blue is a slower marketplace than normal. Then here is just what the marketplace is. So Redwood City, even though it's 61% slower than it normally is, it's only at 51 days, which is, according to my current scale, a balanced marketplace. It's unusual for Redwood City to be in a balanced marketplace, is what it's saying. Here's your time on the marketplace. So you can see it's taking 62 days in the coast to sell your 3 out of 4 sellers to sell. It's the only blue area. There's a fair amount of pink. Most of the areas are in white, which means they're basically what I call a balanced marketplace. Price adjustments are basically either white or blue in color, which means sellers are taking the typical or larger than normal price reductions. Frequency of price reductions. So price reductions are pretty red, which means the frequency is less than you'd expect. Magnitude of overbidding is still pretty good, but again, these are dark orange up here, and that's because these are lagging indicators because you have to wait for escrow to close. One of the things that's interesting is on the magnitude of overbidding, that the lag time on that is less than you would expect when you're up at the peak, and that's because buyers that are being aggressive in their offer are going to tend to offer a quicker close than 3 to 6 weeks. They're going to be coming in with 1 to 3 week closes. And then the last two columns really don't tell you about the speed of the marketplace. It's just what areas have had the highest appreciation, with red being the higher appreciations, blue being the slower appreciations. And you can really see it's San Mateo County that had the least amount of appreciation, and then the expensive areas in Santa Clara County. And then you have the prices. And on prices, instead of just following the median price that most people do, which is in the middle, I follow the lowest price and the most expensive, which I define as the 10 and 90 percentile. So your sandwich, you have a much better idea what price range each area is going to have. Here's your active inventory geographically put out there. So right off the bat, you can see that Alameda County and Santa Clara County have a shortage of inventory. San Mateo County is basically right at the normal level of inventory you'd expect. Offers accepted, you can see that most of the areas are having a blue shade on here. The most significant blue shade right now is in the Redwood City area of San Mateo County. So that's the least amount of buyer activity. Here's DUIs. This is the speed of the market. So here you can see Redwood City and the coast in San Mateo County are the slowest. You can see Cupertino and Sunnyvale in Santa Clara County are the hottest. Most of the Silicon Valley is white in color, which means it's basically normal. You can see Alameda County is at 100%. You can see a lot of the areas in Santa Clara County are at 100%. And in San Mateo County, except for the blue areas, they're just over 100%. Here's your days on sold inventory. So even though this is just in raw count, so this is just how fast the market's going, you can see the coast is sort of a blue color. You can see the expensive areas in San Mateo County are the bluest at 94 days. And that's sort of right at my cusp. And then the red areas are the areas that are moving the most rapid on there. And they're sort of the more affordable, more outlying, longer commute timeframes. Here's time on the marketplace for those that don't like statistical numbers. This is just how long is it taking the 3 out of 4 sellers to sell. You can see it's taking 3 weeks out on the coast, which is a long time frame. Most of the area is either white in color or a shade of pink. Here's your ask price reductions. That the coast, is taking 4.5% off the seller price when the offers come in. Redwood City is almost 2%, 1.9%. Oakland is at 2.6%. Here's your frequency of price reduction. So very common on the coast, with 53% of the sellers taking price adjustments, more than half the sellers. Oakland is also pretty cool at 31%. This is the magnitude of overbidding. So this is the average overbidding. You can see it's actually better than one would expect. So buyers are still overbidding. Again, I want to caution, this is going to tend to be a lagging indicator. Berkeley up here is one of the hottest area, the Berkeley and the city of Alameda. Here's the frequency of overbidding. How common is overbidding? The redder the color, the more common. So you can see the expense varies in Santa Clara County are normal. Everybody else is red, with the exception being the coast, which says overbidding is only at 17%, which may sound like a lot. 1 in 6 sellers getting more than their asking price, but that's actually fairly cool for Silicon Valley. Here's the appreciation. You can see San Mateo County across the board is blue, which means less appreciation. Santa Clara County and the Tri-Cities area of Alameda County is where the real appreciations occurred since 2015. Here's your sold price. The more affordable areas are your outlying areas. The more expensive areas are the ones that are close to the job centers. And you have again, the cheapest 10 percentile. This is Campbell, Cambrian, Willow Glen. So you go from 1.4 million to 1.9 being the median. That's only a $500,000 range. And then you go from 1.9 to 2.7 for a range of $800,000. And that's pretty typical. If you're in the lower price range, a little extra ability to purchase by doing a buy down, getting a more aggressive loan, doing a loan that's fixed for 7 years, those kinds of things get you a lot more house. Here is showing you that Silicon Valley, were only sold 2003. This number will continue to go down, but it's higher than we were last year. So recently we've been in this pattern of being low but higher than last year, with last year being the record low level, 2023. Here's the actual raw numbers for Santa Clara, San Mateo, Alameda County, or Silicon Valley combined. So you can actually come and get the raw numbers of whatever metric is most valuable for you. And with that, we've been talking about Silicon Valley real estate market analytics. This is for the week ending August 10th, or being presented August 10th. And then we're gonna, after we finish up this and I'll post it, I'll go into the Greater Bay Area, which is 13 counties, 5 regions. The blue is my YouTube direct archive channel. You can go and look at any episode you would like. This green URL is what I call my root URL. That takes you to the YouTube channel if you want to do less typing. You add in 2024 at 9 o'clock Saturday morning, and you get to these live presentations where you can ask questions. And then you come down to get the handout. You put in the letter H for handout, 2024-08-10 to get this week's handout at 66 pages. My goal is to get it up about 10, 15 minutes beforehand, and I did accomplish that today, so it's there. And any specific episode, you can put in the green root URL, the year, month, date code. I'm Richard Calhoun, Creekside Realty, working with buyers and sellers here in Silicon Valley. My contact information, and let me see if anyone's got any questions. Not seeing any unmuted mics, I will move on and start covering the 13 counties in Northern California with their 5 regions. They are listed here for you. You can see that inventory in the big 3 regions is increasing. It's also increasing in the Central Coast. The one exception is the city of San Francisco and Marin, and it's actually going down in that one region. The area that's missing, the region that's missing the most of its inventory is probably the Central Valley on a percentage basis. It's normally up there with North Bay, and now it's right down with Silicon Valley. North Bay would be close second, but it's got more inventory relative to Central Valley, and therefore Central Valley is the one with the least amount of inventory. Here's the number of offers. Now you can see historically, all 3 of the bigger regions are very similarly together. All 3 are together. What's noteworthy here is Silicon Valley had a huge number of offers being accepted, and it's now dropping, and it's been dropping since halfway through second quarter, where your North Bay in the gray and your Central Valley in the yellow are both increasing sharply at this time. So there's definitely a difference. And if you look back historically, the pattern for the three regions that we're talking about is the same. So the fact that Silicon Valley is going down and Central Valley and North Bay are going up is an interesting observation. Here's the days of unsold inventory. So the speed of the marketplace, Silicon Valley is the fastest. San Francisco and Marin, the cities, has been dropping, which is an improving marketplace. At the same time, Silicon Valley has been slowing down. So the two are now neck and neck at about 45 days, 42 days, maybe, because it's a tight scale. The slowest region is the Central Coast. North Bay and Central Valley are following the same pattern. Here's your marketing time. Silicon Valley here shines with the least amount of marketing time at 22 days. The next closest is the Central Valley at 32 days. And then you're up to San Francisco, Marin, the cities, Central Coast, and North Bay, all between 42 and 44 days. So there, 3 of the 5 regions are grouped very closely together, just at 6 weeks. Here's the ask price reduction. Silicon Valley has had the least amount of price reductions. All 5 regions are increasing in the amount of price reductions, and the Central Coast has the most amount of price reductions. But you can see that price reductions are increasing in all regions, which is a strong indication that the market is slowing. Here's the frequency of seller ask price reductions. All of them are increasing, so price reductions are becoming more and more common in all 5 regions. Here's the amount of overbidding, and this is the magnitude of overbidding. So the magnitude in all 5 regions is decreasing. The Central Coast is below seller's asking price at about 99%. The yellow, the Central Valley, is right at 100%. Then you have North Bay at about 101%. And then Silicon Valley and the cities are very close together at about 5.5% above the seller's asking price. Frequency of overbidding, here you have a nice separation. You have Silicon Valley with the most, right at 68%, followed by San Francisco and the cities at 54%, then North Bay at 46%, then the Central Valley at 43%, and finally, with the least amount of overbidding, the Central Coast at 37%. Appreciation for long term, the cities, San Francisco and Marin, has the least appreciation at something like 34% appreciation. Then the next closest is the North Bay at 68% appreciation. And the remaining 3, Central Coast, Silicon Valley, and Central Valley, come close together. It is noteworthy to point out that Central Valley has the highest appreciation rate at 93%. Silicon Valley has the second at about 86%. And the third highest is the Central Coast at 84% appreciation. And that's since the last 9 months of 2015. Here's the median sold price for the region. So you can see that Silicon Valley is now slightly more expensive than the cities. Central Coast is the third, North Bay, and the most affordable is the Central Valley. Payments, assuming 80% loan at the national federal average rate, which is 6.47, and I know locally Wells Fargo was at 6% last week, I think it was. So you can get your payments lower than this, but it gives you an idea of what the payments are. All 5 regions are going down. The Central Valley is going down the least, and I'd almost call it flat, except the other 4 are going down. Here are the actual numbers for each one of the 13 counties. I also have Silicon Valley and the Bay Area, the 9 counties that touch the Bay, in there. And the reason I do the Bay Area is simply because the media quotes about the Bay Area a lot. And, I just want to point out, and this is why the Bay Area data makes no sense at all. The average overbid for the Bay Area is 3.8% above the seller's asking price, but the range is anywhere from 1.8% below the seller's asking price in Napa to a high of 9.9% above the seller's asking price in San Francisco. So to paint that wide range saying it's 3.8% overbidding just doesn't make any sense to me. And with that, we've been talking about the Silicon Valley real estate market analytics update for August 10th. And we just finished up with the Greater Bay Area and the 13 counties. Already talked about this URL. Go back to the end of the Silicon Valley details to get that. I'm Richard Calhoun with Creekside Realty, working with buyers or sellers here in Silicon Valley. Thanks for listening. Take care. Bye for now.